This is Matt Graham with the MBS Live Market Update. Last week was a holiday shortened one with Labor Day on Monday and markets getting back in the office to find yields higher on Tuesday. Some of that was driven by gradual weakness in the global bond market that took place on Monday. But then on Tuesday morning, there was a big glut of corporate bond issuance. This is something that definitely impacts treasuries and MBS because corporate bonds compete for investor attention, and they are also hedged using treasury sales, or they can be, and that can create additional volatility and weakness in the short term, although the weakness that results from hedging isn't always a lasting weakness. It can be a zero-sum game where buyers come back in and buy back those hedges after the issuance process. Nonetheless, it was definitely the corporate bond issuance scenario that pushed yields higher on Tuesday. It was the fifth biggest day of all time for new corporate bond issuance, and moreover, the top 4 days all had benefited from at least one extremely large offering of $25 billion or more. And that made last Tuesday all the more notable because the largest bond offered that day was only $4.75 billion. So that really speaks to the breadth and volume of deals being offered. The next day was also quite large. The week in general was on pace to be a record-setting week until the last 2 days, and that kept pressure up. But on Wednesday, negative momentum was added by ISM Services. That is the non-manufacturing PMI data from ISM, one of the more important economic reports out on any given month. Came in at 54.5 versus 52.5, and the prices component also rose more than expected. Bonds definitely shot higher after that, and then spent the rest of the week leveling off in general. Thursday was a bit stronger, Friday was a bit weaker, and that was the end of it. Now heading into the new week, we have a confluence of important events. Really, the confluence occurs over the next 2 weeks. This week's key event would be CPI, Consumer Price Index, on Wednesday. This hasn't been as big of a market mover as it had been in months past. So the last report wasn't a huge one, but it's important to note that they have been coming in right in line with expectations. This one has a bigger departure from the previous forecasts due to the uptick in fuel prices, creating expectations for higher headline inflation. The consensus is still for 0.2% at the month-over-month core level. If that were to be higher than expected in any meaningful way, so 0.3 or higher, I do think we could see a reinvigoration, another test of the high yields of the past few decades and highest mortgage rates of the past few decades as well. If that number were to be lower than expected, and especially I think the headline could get more attention this time because everyone expects it to be a lot higher due to fuel prices. If that were to be lower than expected, and if that spilled over to a lower than expected core reading, that could be favorable. We could see, a little bit of a hopeful correction. And it will probably be exacerbated by the fact that we have the Fed meeting coming up next week with a new dot plot and, of course, a press conference, as always. But that means the Fed is in their blackout period for this week where they refrain from commenting on monetary policy. Sometimes that results in the market trading key data for the Fed in a more aggressive way, as it's sort of trying to guess what that data will mean for an evolution in the Fed's communications. Beyond CPI, retail sales on Thursday, it's expected to remain in positive territory, but at only 0.2% this time versus 0.7% last time. And other than that, no true top-tier data. Consumer sentiment on Friday, import prices, New York Fed, industrial production, those are all second-tier market movers at best, but can still have an influence in the little picture. As far as longer-term rate outlook, I do think that things remain data dependent. We've seen other reasons for rates to move, such as corporate bond issuance last week, but it will ultimately be the data that guides the Fed and guides the market's either reaction to the Fed or anticipations of how the Fed will react to the data.